All right, guys. So this is just gonna be one of my many series that I'm gonna be making about the. This is for beginners, I should say, right? And moving forward, it might not really relate to market structure in the sense that higher highs and a higher low and the likes. It's might come to do with it, but we would majorly be dealing with the move, the traps, and the liquidity, and where price is likely to attend or go to. So let's get started, right? Let's say we have a trend like this, all right? A trend like this. This is price coming down, right? Bearish trend. We call it bearish. Bearish. Let's just call it a bear market, right? Bearish. And then, of course, the one that goes up like this is what we refer to as the bullish market. You can see the trend going up. So this is the bull market. Bull. Okay, so now I'm going to clear that. Then I'm going to go exactly what I'll talk about exactly 3 times. Okay, so what we look for when we have a move to the upside like this, the first thing we want to look for when price is coming back down like this are those points that touched each other. Now, by touched each other, what do I mean? We can see from this image that if we say from this low to this high, this guy didn't come to touch inside of this box, right? That's the first thing to note. If we continue with the follow-up like that, the next line didn't come to touch this particular one as well, right? The next one didn't touch as well. This next one didn't touch as well. You can see from the low to the highs, right? Now, this one, what happened? It came and touched it. So this came back into it. After it broke out of this box of this low to this high, price came down, came back into that zone, right? And then the next one, what happened again? Price also did the same thing, coming into the zone. So what does this tell me? It tells me this area right here could serve as a potential POI. Now, POI means point of interest. It serves as a point of interest because all of those guys that has been mitigated automatically become your liquidity, right? So this is your trap, this is your trap, this is your liquidity, and from your liquidity point, you can put your entry here like this. So for those of you who don't know what entry means, no problem, we'll come there. You can put your entry here, target a particular low that we'll talk about later on. I know you don't understand yet, it's fine, but just follow the steps. So this could be your entry, and the other one could be from this line. The only difference between this and this is one would make your risk to reward bigger. So if you were risking 1,000 naira or $1,000, your money here says 8.86. So you'll be making that 1,000 naira times 8.86. So that's 8,000 naira, 86 something. And if it's as $1,000, it would be $8,000 and 86 something as well. But then, whereas if you put it here, it increases the amount at which, it reduces the amount at which you're going to be making. So from 8 now, it has become 5. And as you can see, if I drag it and make the red box bigger, it reduces. So that is basically how that works. And I don't want you to be all about what you can make. It should be majorly about how consistent you can keep doing it to grow your capital. So don't rush into it with all your volume and all of the things like that. So in this case now, what price is going to do is price is going to come up, respect this as well, like it wants to work well, but what is it going to do eventually? It's going to go up, come inside this level here, test that zone. You would test it. And when you see the test, don't be happy that, yeah, I'm in profits, because it's going to come back up. Not necessarily touch inside here sometimes, but it would touch it also sometimes before price decides to go back lower and respect you the way you want it to happen. Now, this is what you need to note, right? There are some days where your analysis is right and everything you do is correct, but for some reason, the market just decides to take you out, right? It happens like that. But because of that, do not let that discourage you from how you trade and the way you trade, okay? So you need to be concise about it. Now I'm going to invert the screen now and show you, this is for a bear market, a bearish trend coming down. So I'm going to invert the chart now. I don't know where we do it. So apparently I want to turn it upside down, but I'm not getting it. I can't remember how. Log vertical cursor line by time. Anyways, so I'll just draw another one. So this is for a price that is coming down. You need to understand where your liquidity is, where your entry is, and boom, the price would respect you. All right. Now let me delete this, and then we'll do another one for the opposite direction. So now in this case, price has fallen down, right? You can see the move. Then you have price doing something like this, 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 like so. And your target overall is this line right here. What you need to note and know is the first thing to do is just like previously, from this low to this high in this case, because the price is going higher, right? Next draw on liquidity. The next one from this high to this low. You touched it from this high to this low again. As you can see, it touched it. It touched it. So meaning what? All of this right here automatically are liquidity points, are traps. Then your liquidity points becomes here. So this is where price is gonna come and pinch out before reversing back up. So it's something we call inducement, but we'll come to that in the nearest video. All right. So in this scenario, this would be how you trade this. You stop exactly at this place right here. You target the highs. All right. So of course, what is price gonna do? It's gonna come and take out all of that. It's gonna dance a little bit, test you, then finally doing the right move before price goes to your right direction. So this happens every single time. This is exactly how it works. Remember, the major thing is to understand that whatever area has been mitigated automatically becomes a trap, and then it would only use that as a trap until it has reached the liquidity point that started the mitigation. So all of this coming to touch inside here are places or things we call a mitigation area. Now, let's go to a live market so that you all can see exactly what I'm talking about. Okay, I'm gonna go to 5 minutes time frame. So let's use yesterday's price action as an example. Okay, we can see price doing what's here. Price swept all of these guys, inducing it going up. Price the same thing, inducing it going up. Price went up higher. Now remember what I said about series of mitigations becoming a trap, and then price would come later to induce the start of it as liquidity before price continues higher. Now let's use this as an example. What can you all see from this particular view right here? What I can see is that price, right? What did it do? It came inside this high to this low, and price came down, touched it. That's the first thing to note. The second thing to note is what? Price also what? Did the same thing here as well, from this high to this low in this case, continuously going up. Now when price came back, it also tried to respect this one as well. Let me just use the last one below here. You can see price came into it over here, went back up, like it wanted to respect it the way this one respected the price and went back higher. But what did price do? It came back to take out the start of the mitigation. Then what happened? It created the test. I'm going to do this in red. It created the test, and after the test, people would want to use this test and follow through, but no, you have to be very, very careful. you can place your order down, but remember that most of the time there is always a test. It doesn't happen all the time, but most of the time there's going to be a test, and then price is going to drop back down into that same area that you've marked, and then price was going to go up. So as you can see, that was exactly what happened here. And then by this line, you put in your entry, put your stop loss. You can put your stop loss here if you want to be conservative. You can put it here, no problem. You can put it here, no problem. You can put it here, no problem. But the major thing is to put your stop in a place that regardless of how market dances, you are sure that it will never come to take you off. We're going to discuss how you're going to do that later in the future. But for now, you can just set your TP here. TP means where you take your profit. Bam. This is a 1 to 4.5, approximately 1 to 1.5. Let's look for another example and then we'll continue from there. So this is the first one. The second one is going to be this guy. Price is going up still. Remember, this becomes the one that's touched, mitigated this, price went back higher, right? After price went back higher, let's go back into lower time frame to analyze that properly. After price came inside of here, price also did what second time, tried using this place, price came inside of it, went back higher. And when price came back down, what do we see? We can see price respected it, came back lower, went back higher. But remember what I said again, what do we see? A test. After the test, then price moved in the right direction. Okay, so that is exactly how price moves. Okay, that's exactly how price moves. We can continue again the same pattern over and over and over again. You can see from this low to this high, price came, respected it, went back higher. If you want to use something inside, we can just say, okay, price came, tapped here. Okay, the next one came from the low to the highs, tap this one, respecting it. Automatically, all of this right here becomes your what? These are your traps. This is your liquidity. And then what do we see? The what? The trap. Sorry, the test. Then after the test, price came back lower and then moved up. So in this case now, your entry is going to be where? From this line, your stop below here, and then whatever your target of the higher time frame would have been. In this case, this was the trade breakdown. And as you can see, price did exactly that, right? So the point I'm trying to make in this whole scenario is what? You need to always follow your plan, because that's the way to do whatever it is you want to do that has to do with trading like this. All right. So I'm going to post the next video soon, maybe today, maybe tomorrow, I don't know. But I'm going to make sure that I make this series complete for everyone who wants to understand properly how this works. So you all have a great one. Peace, guys.